So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals to fundamentals, starting with Euro USD. This is the 4-hour chart you're looking at. Practically all charts to be presented are to be of the same time frame unless otherwise stated. Now we can see that Euro USD, despite some volatility in the early American session on Friday, due to the release of the US employment report for February, which presented some volatility. Overall, the pair tended to maintain a sideways motion. It was interesting how the volatility of Friday practically reaffirmed the R1 1.0982. See the touch here? Yet overall, it stabilized a little bit lower, practically between the R1 and the S1. Note how the RSI indicator dropped. It's currently at the reading of 60, which still implies that there is a residue of a bullish sentiment in the market for the pair. Given also that we have the upward trend line which remains intact. Given also that you have the 20, the 50, and the 100 moving averages all pointing upwards, I would be inclined to maintain the bullish outlook. And I'm going to be keeping it as long as the upward trend line, you can see right here, initiated at the early days of March, would remain intact. Should the bullish outlook be maintained, we may see the pair actually marking a higher peak than this one. So the price action has to breach the 1.0982 and start actively aiming for the 1.1040. On the other hand, should the pair stabilize, I would expect the price action in the next 24 hours to test, if not breach, the upward trend line we had mentioned. While for bearish outlook, definitely would require the breach of the upward trend line, signaling an interruption of the upward movement. But for bearish outlook, I would also require the pair to breach below the S1 1.0890 support line and start aiming for the S2 1.0795. Now, at this moment, it would be useful to have a small discussion about the release of the US employment report for February. That was practically in the early American session on Friday. Now, overall, the data tended to imply that we had a widening, or if you prefer, a rise of the unemployment rate. It jumped from 3.7 to 3.9. Now, the rise of the unemployment rate was, in my opinion, a signal of how the tight monetary policy of the Fed had an adverse effect on the US employment market. More or less, that was an element which tended to weigh on the US dollar. On the other hand, though, the NFP figure, we have to note that the comparative reading of January was revised downwards, and it was revised to reach practically, give me a sec, 229K, which, given the new release of February, which was at 275K, that tended to imply an improvement. It provided some comfort, I have to say here, but the data tended to more or less trouble traders. So once again, for the time being, the key takeaway in our opinion would be practically that there is, I wouldn't say a slack, but an easing of the tightness of the US employment market. Overall, though, on the other hand, the Fed may start worrying given the rise of the unemployment rate. But if considered that the bank maintains practically or looks at an average of the past few months, it may still hold out regarding keeping rates higher for a longer period. We would require to see an even worse situation in the US employment market before actually expecting that the Fed would be, let's put it this way, start cutting rates. And given that we had already the release of the US employment report for February on Friday, next big test for the dollar is expected to be the release of the US CPI rates for February that you are tomorrow during the early American session. Should the rates actually fail to slow down, that may contradict market expectations for the Fed to start cutting rates early. And in such a case, we may see the USD getting some support. While on the flip side, should the rates actually do decelerate and substantially may add, then we may see the market's expectations for early rate cuts being enhanced. And in such a case, we may see the USD weakening. May I also remind you guys that Fed Funds futures currently imply that the bank may proceed with 4 rate cuts, or at least that's what the market seems to be pricing in right now, starting from June onwards. Okay, let's have a look at USD JPY. Now USD JPY dropped, breaking the 147.75 support line. Now we have to turn this into a resistance. And let's go hunting for a new ultimate support level. I would be noting this level here, as practically it has provided resistance in the past and also some support here. That's quite interesting. Another level which could be added would be here, but in my opinion that's too close to the S2. This would be better. Okay, I understand it's a prior resistance line, but given that the price action is above it, could serve as a support line. And that would be the 142.80. Readjusting the chart, let's correct the labels. $150.80 now being set as the R3. 149.60 being set as the R2. 147.75 first resistance line. First support line now being set at 146. Second support line at 144.35. And the final support line at 142.80. Now definitely the pair seems to be maintaining a downward motion, and that's been characterized practically by downward trend line, maybe not exactly like this. I think this would be better. The RSI indicator continues to be clearly below the reading of 30, implying a strong bearish sentiment. At the same time, though, may also be implying that the pair is at oversold territory and maybe ripe for a correction higher. Yet, I would say that a correction, which definitely is in the cards for the pair, may be a little bit premature, given that the price action still has some way to go before meeting the lower Bollinger Band. So for the time being, we tend to maintain our bearish outlook and note how the 146 support line provided support here, but also resistance here. So should the S1 be broken, which is the next target for the bears, the way would be paved for the 144.35. We're talking about 165 pips lower here, which is pretty wide. Mind you that the S2 has provided support here, so that provides some validity to it. On the flip side, should the pair stabilize, I would expect it to breach the pre-mentioned downward trend line, signaling more or less the interruption of the downward motion. But for a sideways motion, it would have to remain in the boundary set between the R1 and the S1, which is also a pretty wide corridor. We're talking about 175 pips here. While for a bullish outlook, I would require a total reversal, i.e. meaning that the price action of USD/JPY has to reverse direction, move upwards, break initially the downward trend line, once again highlighting the interruption of the downward motion. But I would also require for a bullish outlook the pair to breach the R147.75 and start aiming for the R249.60. On the fundamental side, okay, we have mentioned already the fundamentals regarding the US dollar. For the JPY side of the pair, definitely BOJ's intentions remain key to the direction of JPY. And market expectations for a possible rate hike, even a slight one, practically signaling the start of a normalization effort for the bank's ultra-loose monetary policy, could continue to provide support for the Japanese yen. Mind you that if I'm correct, tomorrow during the Asian session, BOJ Junior Finance Minister Kada will be speaking. Should there be any innuendos about a possible market intervention to JPY's further strengthening by the Japanese government, that could actually provide additional support for JPY and push the pair lower. Okay, let's have a look at GBP USD. Yo, that's interesting. Let's readjust the labels so we get a clearer picture here. But definitely the fact that the price action has breached the 1.2775 and seems to have hit a ceiling at the 1.2870 cannot pass unnoticed. The R1 now has to be turned into a support line. Let's lock this in. And let's go searching for a new ultra high level for the cable. This peak would be more than enough. I know the resistance lines are pretty wide, but currently 1.3140, yep. Currently symmetry is not one of my main worries here. Starting with the S3 now being set at 1.2615, the S2 at 1.27, the S1 at 1.2775, the R1 at 1.2870, the R2 at 1.2995, and the R3 at 1.3140. Locking everything in. Now the big question here is whether the upward motion is to continue or not. On the one hand, we saw that there was an intensification of the upward movement in the past few days, yet that was breached. Give me a second. And that was one, and then we had another one. So there are some tendencies of stabilization. But, and it's a big but, we see the RSI indicator which has corrected lower, and at the same time you can see that the price action of cable corrected lower, or if you prefer stabilized, after hitting on the upper Bollinger Band. So some correction lower was in the cards for the pair, and it materialized. But the RSI indicator remains at the reading of 70, implying that there is still a strong bullish sentiment for the pair, which could push it even higher. In my opinion, the upward movement may regain traction, and if actually so, we may see the price action of cable breaching the R1 1.2870 clearly. Maybe even the 1.2870 will be providing some support to the upward motion. And in that case, the next possible target for the bulls would be the 1.2995. We're talking about 125 pips here, which is pretty wide even for cable standards. On the other hand, should the sideways motion be maintained, I would expect it to remain just below the 1.2870 resistance line. For a bearish outlook, I would require the pair to drop, breach the 1.2775 and start actively aiming for the 1.27. At that point, we may be discussing even a possible widening of the support lines. Okay. On a fundamental level, let's put it this way, I would expect to see some market reaction on cable. Okay, we have already mentioned the US dollar fundamentals. But on the pound side, we may see the market reaction because, if I'm correct, BOE rate setter Catherine Mann is scheduled to speak tomorrow, and should she comment on monetary policy, possibly on the hawkish side, we may see some strengthening of the pound. I would be also noting the release of the UK employment data, and at this point I would be highlighting the employment change figure, the unemployment rate, both for January, and also the average earnings growth rate for the same month. And should the unemployment rate tick down or even remain unchanged, that would imply a continuance of the tight UK employment market, which could provide some support for the pound. At the same time, though, I would be also noting that markets are going to be keeping an increasing watchful eye over the release of the UK employment change figure. A possible rise of the figure could provide also some support for the pound. Other than that, I would also be keeping an eye out for the release of the GDP rate for January, as well as the manufacturing output growth rate for the same month. A possible acceleration, especially of the GDP rate, would be a signal that the UK economy may be avoiding a recession. And that's, in my opinion, on the growth side of the economy, quite crucial. Okay, let's have a look at USD CAD. Now USD CAD has dropped practically, I didn't say bounce, it even at some point breached the 1.3450, yet corrected higher. And at this point, it would be interesting that the latest movement would be forcing us to lower the first support line to 1.3435. It's exactly highlighting the point at which the price action bounced, and we're going to be redrawing the rectangle showing the sideways motion of the pair. So for the time being, with a correction lower of the S1, the sideways motion seems to continue. The RSI indicator has corrected higher, is above the reading of 30, but has some way till 50. It's at 41, so there may be a residue of a bearish sentiment left in the market for the pair, which could ultimately drive it lower. By the way, also note that we have the 50 and the 20 moving averages both pointing downwards. Okay. So there may be some bearish tendencies here. Should the bears take over, I would require the pair to breach clearly the 1.3435, possibly with the S1 being turned into resistance line and actually providing some resistance, and the pair to start aiming for the 1.3320. That would also allow us to start drawing a nice downward trend line showing us the limitations of any downward motion. On the flip side, should the sideways motion be maintained, we may see the price action remaining above the S1 1.3435, maybe even correcting a little bit higher. For a bullish outlook, which in my opinion seems to be quite difficult, because for a bullish outlook, the pair has to breach the 1.36. It has to mark a higher peak than these ones, which actually highlighted the resistance level at 1.36. So it has to rise, breach the 1.36, and start aiming for the 1.3695. It's a little bit out of the ordinary, or difficult if you prefer for the bulls to take over. I would be noting here that, okay, we had also the release of the Canadian employment data for February on Friday's American session, just before it started anyways. And at that point, we saw that the data were mixed, given that on the one hand, we had the unemployment rate, which ticked up from 5.7 to 5.8 as was expected. But on the other hand, we saw that the employment change figure, which was expected to drop a bit, did not. It actually moved upwards even slightly, which was a positive for the Canadian dollar. So you got some mixed signals there for the Canadian employment market. I do not think that these data will be changing in any way BOC stance just yet. Okay. Let's have a look also at the Aussie. Now, we have two elements which are very, very obvious here. The first element is the fact that the upward motion of the pair has been interrupted after hitting a ceiling at the 0.6655. It even briefly tested it, it breached it, but it was a false break and the pair quickly came back down. Seems to be stabilizing for the time being between the S1 0.6595 and the R1 0.6655. I would expect more or less for the sideways motion to be maintained, so I'm switching the bullish outlook in favor of a sideways motion bias, given also that the upward trend line has been breached. Now, for the time being, I would be noting that the Aussie seems to be quite sensitive to the market sentiment. Now, given that the Aussie is a commodity currency, it's considered of riskier nature. Hence, should the market sentiment turn more risk averse, that could weigh on the Aussie. And in such a case, we may see AUD/USD dropping, breaching the S1 0.6595 and start aiming for the S2 0.6535. On the flip side, should once again a more risk-oriented approach be adopted by the market, we may see the pair rising, breaching the R1 0.6655 and start aiming for the R2 0.6730. Now, on technical level, I would be noting here that, okay, we have the 20 moving average, which is on the rise, practically reflecting the intense rise of the price action over the past few days, yet the rise of the 20 moving average is missing out on the stabilization here. The RSI indicator, on the other hand, has corrected below the reading of 70, yet remains pretty high at 62. So there's still a residue of a bullish market sentiment still left, which could push it upwards. It's going to be interesting to see where the Aussie will be landing in the next, in my opinion, 5 days. For the time being, once again, I'm highlighting the switch from bullish outlook in favor of a sideways movement bias. However, that's only valid until the market decides on the direction of the pair's next leg. Let's move out of the FX market. Let's have a look at gold. And for gold, allow me to go into the daily chart. Let me reposition the labels. Now gold is at record high levels. That's more than clear. And let's readjust also the upward trend line guiding it back to the 1 hour chart. Somewhere here. Let's widen this. Now some stabilization back to the daily chart. Now some stabilization of the precious metals price was expected, and note how it's about to breach the upward trend line guiding it. Actually, the gold's price is currently struggling with the 2180 resistance line. Should the bulls maintain control, I would expect the gold's price to breach the R1 clearly, and start aiming for the 2230 barrier. On the other hand, the possibility of a stabilization of gold's price is quite obvious, and to this end I'm highlighting that practically the RSI indicator has reached at the reading of 83, which is very high. So once again, the RSI indicator is highlighting the bullish sentiment of the market for the precious metal, but at the same time maybe warning that it has reached overbought levels and maybe ripe for correction lower. So should the correction actually materialize, there are two options here. The first possibility is that the precious metals price will be stabilizing between the 2180 resistance line and the 2136. In my opinion, though, I would expect it to remain near the R1. On the other hand, should the bears take full control over the precious metals price, I would expect the price action to drop and at some point breach the 2136 support line, signaling the initiation of a bearish outlook, possibly starting to aim for the 2090 within the next week. Once again, though, for the time being, the bullish outlook is maintained, and I would expect the price action to breach the R1 2180 clearly and start aiming for the 2230 resistance level. Okay, let's have a look at US stock market, starting with Dow Jones. Dow Jones in the daily chart, sideways motion. Let's correct the label so we get a clearer picture. It seems as if Dow Jones has hit a ceiling at the 39,000 levels and remains below it. The upward trend line which was guiding it seems to have been breached. The RSI indicator is running along the reading of 50. All of that tends to imply more or less that this upward motion has been interrupted, the bullish outlook has been interrupted, and we would be switching it in favor of a sideways motion bias, at least for the time being. Should the bulls regain control over the index, we may see it rising, breaching the 39,000 resistance line clearly this time and start aiming for the 40,000 resistance level. On the flip side, should the bears take over, I would require the pair to drop, breach the S1 38,000, which would be opening the gates for the 37,100. Okay, let's have a look at S&P 500, which the importance of switching between indexes regarding US stock markets is highlighted by the fact that Dow Jones takes only a narrow path. We're talking about only 30 companies. However, that could be misleading in the sense that those 30 large companies could actually be doing well and the rest of the stock market may not. So always for a rounder picture, have also a look at the S&P 500, which is more like the general index. It includes 500 companies. It has very wide reach. And you can see how this is the daily chart. The picture here is different in the sense that the upward trend line remains intact. So for the time being, we tend to maintain our bullish outlook. And we're basing that practically A, on the fact that the upward trend line remains intact, B, on the fact that despite the RSI indicator correcting a bit lower, it's still quite higher than the reading of 50. It's actually, let me have a look at 60 something, at 63, which tends to imply that there's still a bullish sentiment left in the market for the index and could drive it higher. In that case, we may see the price action aiming for the 5250 resistance line. Once again, kind reminder, the price action is at all-time high levels, and that may provide some hesitation and cause the index to correct lower. Yet, on a technical basis, I would be noting here that the price action is still quite below the upper Bollinger Band, guiding the index higher, given that the price action is within a channel which moves upwards. So there is still some room for the bulls to play. But should the index correct lower, the first signal of the end of an upward movement would be the breach of the upward trend line currently guiding it. I would also expect a breach of the S1 5100 and the price action to start actively aiming for the 4950. On the other hand, should the bears come into total control, then we may see the price action of S&P 500 actually starting to aim for the 4800 barrier. Yet that would require some time before it actually happens. So we may see that in a bearish outlook happening in the span of the next 4 to 5 days. However, once again, for the time being, our base scenario remains bullish given and as long the upward trend line remains intact. For a more specialized view, I would have a look also at NASDAQ to see the high-tech companies. Let's drill into it is the daily chart already. And in my opinion, there's still a bullish outlook. There was some slight stabilization of the index. Note how it has difficulty actually marking higher highs. The differential is narrowing, which more or less could imply that the bulls are having difficulty to form higher highs in the path towards the 18,800. So for the time being though, and as long as the upward trend line remains intact, I would maintain a bullish outlook and set the next target at 18,800. But once again, a small warning here that we see tendencies for stabilization of the index. For a full bearish outlook, I would expect the price action to drop, breach the pre-mentioned upward trend line, breach the 18,000 support line, aim, if not breach, the 17,165. Given the low volatility of the index currently, for such a scenario to materialize, i.e. to reach the S2, that could require about 4 to 5 days once again. Once again though, main scenario remains, or base scenario remains, for the bulls to maintain control. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
My name is Emily and welcome to another educational video. The word Goldilocks is a reference to the popular children's story Goldilocks and the Three Bears. The term is used in finance to describe an economy that is just right with steady growth and normal inflation. It is an ideal economy that is not too hot and not too cold. In other words, it is a Goldilocks economy. In this balanced and healthy economic system, there is full employment, economic stability, and steady growth. The economy is not expanding too much to push inflation too high, and not slowing down to enter into recession. A Goldilocks economy is also good for investing and trading. In a growing economy, companies also grow and generate positive earnings, resulting in their shares performing well. Goldilocks economies are temporary in nature because there are boom and bust cycles. While there may be disagreement among economists about what the exact characteristics of a Goldilocks economy are, the basic idea is that there is a balance between growth, employment, and inflation. The ideal conditions for a Goldilocks economy are low unemployment. Unemployment is measured with the unemployment rate, which reflects the number of people willing and able to work but unable to find gainful employment and who have sought work in the past 4 weeks. The Federal Reserve estimates a normal rate to fall between 5% and 6.7%. Another condition for a Goldilocks economy is asset price inflation, which refers to an increase in prices of shares, real estate, derivatives, bonds, and other assets. Low market interest rates and low inflation are also important, as well as a steady gross domestic product. The GDP is the most essential indicator for a Goldilocks economy as it measures the value of all services and goods produced in a country and reflects the health of an economy. For example, a negative GDP in 2 consecutive quarters indicates a recession. On the other hand, a sharp increase in GDP can push prices too high and result in high inflation. An example of the Goldilocks economy is the US economy of the middle to the late 90s, but also the US economy after the bursting of the dot-com bubble between 2004 and 2005. Thank you so much for joining us today, guys. See you soon. Bye-bye.
Okay, so as per usual, before we get started, just a risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts. followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the Forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. So firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long bias traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where many stops reside. So you can see here, our sell side is on the bottom where the swing lows are. Buy side is where the swing highs are. So basically, it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement, in short, is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here, which have large real bodies, very short wicks, like you can see here, and that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of a candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is, if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and is reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording, or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay. Sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. If we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have higher lows, or rather lower highs, since it's a downtrend. Okay. So next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter-trend moves. These counter-trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a 3-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right, the fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as overlap resistance or support levels, or in this case it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level and reversed off of it, and same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my. Let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. Shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear? So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so are prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my... Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the Fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw your starting point here and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. Flip zones and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity grabs, which we went through before, are basically the areas in which there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, So if we are looking at DXY, just a random chart, how you basically implement the FVG indicator. Okay, you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. Okay, so you can actually use um these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just going to share all the resources that we use. So basically what I mean by a double fair value gap. So you can look at this website as well. But basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your BPR. Basically, if you were here for our support and resistance levels, we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. Okay, if we go back to the, to my chart here. So you can see that our fair value gap is in this area here. Okay, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, 2, 3, and 4 levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix-up. But yeah, let me know if you have any other questions. Yeah, with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix-up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.